Welcome back to the show. Today, we are looking at a titan of industry that seems to be going through a massive identity crisis. It's a company everyone knows, a truck we see on every street. But the stock chart tells a very complicated story. We are talking about United Parcel Service, UPS. It is February 28th, 2026. And the data we have in front of us suggests this giant is trying to dance, but the floor is a bit slippery.
That is a very polite way of putting it. If you look at the report from US Stock Picker Podcast channel, name US Stock Picker Podcast. The theme for UPS right now is shrinking to grow. It sounds paradoxical, doesn't it? How do you get bigger? By getting smaller. But that is exactly what they are doing. They are shedding weight. Specifically low margin volume from Amazon and trying to bulk up on high margin healthcare logistics.
Shrinking to grow. It reminds me of a corporate diet plan. But let's look at the immediate picture. The stock has had a rally recently, up nearly 10% in the last 30 days. But looking at this report, the near-term signal is flashing a big red wait. Why is that? If the rally is real, why are we hitting the brakes?
Because trees don't grow to the sky in a straight line. Right now, UPS is trapped in a consolidation phase. It's bouncing between 115 and 117. The momentum indicators, like the RSI and MACD on the 4-hour chart, are flattening out. Basically, the buyers are tired. They pushed the price up post-earnings, but now they need a breather. The report explicitly calls this chop. If you buy now at around 106 ton, you're flipping a coin. There is no edge.
So it's a classic case of FOMO, fear of missing out. Investors see the green arrow and want to jump in, but the smart money is sitting on its hands?
Exactly. The smart money is waiting for a pullback. The analysis from US Stock Picker Podcast channel, name US Stock. Picker Podcast is very clear on this. The daily trend is bullish. We are above the 50-day and 200-day moving averages, but the momentum is cooling off. The strategy here isn't to chase the bus, it's to wait at the bus stop. And that bus stop is the $114.50 to $11500 support zone.
I want to dig deeper into the fundamental shift you mentioned earlier. You said they are moving away from Amazon. For years, Amazon volume was the holy grail. Why the pivot? And more importantly, can they actually replace that revenue?
That is the multi-billion-dollar question. Here is the reality. Amazon packages are low margin. It's volume, sure, but it's empty calories. UPS is pivoting to what they call better, not bigger. They are targeting healthcare. Think medical devices, cold chain storage, and small to medium businesses. These customers pay more. The report highlights that while revenue growth is actually negative right now, projected at minus 2.46% for 2025, the quality of the earnings is improving.
Quality over quantity. But there is a cost to this transition. I'm seeing notes here about massive layoffs and driver buyouts. $150,000 to leave your job?
It sounds insane, doesn't it? But yes, the court just approved these buyouts on February 25th. They are offering $150,000 to senior drivers to retire. They aim to cut 30,000 jobs. It's brutal on a human level, but from a shareholder perspective, it's brilliant. They are swapping high-cost labor for automation. They plan to automate 68% of U.S. volume by the end of 2026. This is expected to save them $3 billion this year alone.
$3 billion in savings. That definitely protects the dividend. Speaking of which, the yield is sitting around 5.6%. That is hefty. Is that yield safe, or is it a trap?
The analysis suggests it's safe, primarily because of those cost cuts. The free cash flow yield is healthy at nearly 5%. However, there is a but. The debt-to-equity ratio is high at 1.99. They are leveraged, and they are spending heavily to modernize. So, while the dividend looks safe for now, they don't have infinite room to mess up. They have to execute this network of the future perfectly.
Execution is key. But let's talk about the elephant in the room, or rather, the dark cloud. The report mentions some serious legal headwinds, a fatal plane crash in November 2025.
Yes, this is the headline risk that keeps the sentiment mixed. There are wrongful death lawsuits stemming from that tragic crash in Louisville. Families are suing, and it's getting national media attention. It creates a negative narrative regarding safety and maintenance. Plus, there are lawsuits regarding tariff refunds. These things don't necessarily break the company financially, but they act like a weight on the stock price. It creates hesitation.
It's the wall of worry markets love to climb. So, we have a company cutting costs, pivoting to high-margin healthcare, but dealing with negative press and shrinking revenue. Let's look at the valuation. Is UPS cheap right now?
According to the DCF, discounted cash flow analysis, yes. The current price is hovering around 116, but the fair value is calculated at roughly 142,050. That is a 23% upside gap. The market is pricing UPS as a hold, but the math says it's a buy if you're willing to wait 12 to 18 months. You are essentially buying a dollar for 80 cents because the market is afraid of the transition period.
A 20% discount is significant for a blue-chip industrial. But let's bring this back to the trader or the active investor listening right now. We established that buying today is risky because of the chop. If we are looking at a swing trade horizon, say, holding for a few weeks, how do we structure this?
Okay, let's break down the trade structure. The primary chart to watch is the daily chart. The trend is your friend here, but you need a discount. You are looking to set a limit order between 114.50 and 115.00. This aligns with the 20-day simple moving average.
So we wait for the price to drop about $1 or $2 from where it is now.
Exactly. You let the price come to you. If it hits that 114.90 area, you enter. But you have to protect yourself. The stop loss needs to be at 112.30. If it drops below that, the thesis is broken, the higher low structure is gone, and you get out.
And the target? If we get in at 115, where are we getting out?
The first target is $120.90. That's the recent resistance. If it breaks through that, the secondary target is the 52-week high around 123.70. So you are risking about $2.50 to make about $600 or $800. That's a risk-reward ratio of roughly 2.5 to 1. That is a solid professional trade.
That makes sense. It's disciplined. Now, before we wrap up, I want to zoom out. We are talking about automation, layoffs, and efficiency. It feels like UPS is a microcosm of the whole economy right now.
It absolutely is. UPS is a proxy for the global economy. If they are shrinking volume but increasing profit through technology, that tells you where the world is going. Volume, just moving stuff around, isn't enough anymore. You need intelligence. You need high-value logistics. The fact that they are pivoting to healthcare is telling. People might stop buying cheap gadgets from Amazon during a recession, but they won't stop needing medicine. It's a defensive pivot.
A defensive pivot with an offensive cost-cutting strategy. It's a fascinating setup. We have covered the technicals, the fundamentals, and the sentiment. It seems like a classic turnaround play, but one that requires patience.
Patience is the only edge we have left. The algorithms trade the nanoseconds. We have to trade the weeks and months. The wait signal on the near-term chart is the most important takeaway for today. Don't be the liquidity for someone else's exit. Wait for your price.
Well said. Let's bring this all together for our listeners. We have thrown a lot of numbers at you. Support levels, DCF values, revenue declines. Let's distill this into a clear, actionable plan.
Right. Here is the final breakdown based on the U.S. Stock Picker podcast channel name, U.S. Stock Picker Podcast Report.
Let's run through the checklist. First, what is the overall market vibe?
New sentiment analysis. It is mixed to neutral positive. The operational efficiency and quote cuts are the positive drivers, but the legal lawsuits regarding the crash are creating short-term drag. The market is climbing a wall of worry.
And the health of the company itself?
Fundamental analysis. The score is positive. Despite negative revenue growth, the better not bigger strategy is working. Margins are expanding due to the $3 billion in cost savings, and the ROE is excellent at 35%. The stock is undervalued by about 23%.
Okay, the big question. When do we pull the trigger?
Recommendation of when to start investing. Do not buy today. You want to focus on the swing horizon, which means looking 3 to 15 days out. Wait for the consolidation to resolve into a pullback.
And specifically, what price tag are we looking for?
What price point to start investing at? Set your limit orders in the entry zone of $114.50 to $115. This is where the risk to reward ratio shifts in your favor.
Once we are in, when do we cash out?
When to leave the market. You should look to exit or take partial profits when the price tests the upper resistance levels or if the trade takes longer than 15 days and momentum dies.
And finally, to protect our capital, where is the exit door?
What price point to leave the market at to mitigate risk? If the price drops to $112.30, you exit. Furthermore, for profit taking, your first target is $120.90. Don't get greedy.
Clear, concise, and actionable. UPS is a giant in transition, and if you play the levels right, there is opportunity in the chaos. Thank you for listening.
Stay disciplined, everyone.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.